Imagine staring down a massive $7.5 billion revenue hole because Apple, one of your biggest customers, is officially cutting the cord on a massive modem deal. You'd think the market would absolutely punish that stock, right? Well, paradoxically, Wall Street just handed Qualcomm a $15 billion victory lap instead. And that massive single-day surge in market cap? It actually wasn't driven by smartphones at all. It was triggered by whispers of a mystery custom silicon deal with an unnamed cloud giant. This is a massive tell. It's a definitive signal that the undisputed king of mobile chips is marching straight into NVIDIA's data center backyard. When you consider this divergence, losing Apple but gaining billions in value, you realize sentiment has completely flipped. For years, investors held Qualcomm hostage to the Apple upgrade cycle. But we aren't just reacting to a quarterly earnings beat right now. We're watching a fundamental re-rating. Institutions are waking up to the fact that Qualcomm is evolving from a cyclical, seasonal smartphone component supplier into a foundational architect of the broader AI economy.
The $15 billion mystery. To really understand this repricing, we have to look past the headline numbers. The financial press was all over a staggering 173% surge in earnings per share. But if you dig into the accounting, that wasn't some sudden explosion in chip sales. It was actually driven by a massive one-time $5.7 billion tax windfall, essentially a financial sugar high.
But the brilliant strategic move here isn't the windfall itself, it's how management decided to weaponize it. They didn't let that cash just lazily sit on the balance sheet. They immediately authorized a sprawling $20 billion stock buyback program. By doing that, they're aggressively setting a firm floor for the stock price. They've engineered the exact fiscal flexibility they need to execute what is going to be an incredibly capital-intensive pivot. Escaping the Apple cliff. So let's talk about that Apple exit. When Apple inevitably moves its 5G modems in-house, it absolutely leaves a $7.5 billion gap by 2028. But institutional capital isn't panicking. Why? Because they're starting to view this customer loss as a strategic blessing. It forces Qualcomm to shed a high-pressure, incredibly low-margin commodity business. And now they get to take those exact engineering resources and redeploy them into the highly lucrative, high-margin world of custom AI silicon.
The inference economics pivot. We are rapidly entering the era of inference economics. Right now, the major hyperscalers, think Microsoft, Google, Amazon, are absolutely desperate to drive down their cost per token. That's the actual price of generating an AI response. Training a massive model takes the raw brute force of an NVIDIA GPU. But running that model every single day for millions of users, that requires highly specialized custom chips, or ASICs, designed to squeeze maximum execution out of every single watt of power.
And this isn't just some abstract problem floating in the cloud. It is hitting the real world hard. In certain states where these data centers are heavily clustered, residential electricity bills have literally spiked by 267% over the last 5 years. The grid is straining under the weight of this infrastructure build-out. So the physical limits of the AI boom demand extreme power efficiency, and power efficiency just so happens to be Qualcomm's entire corporate DNA. That's exactly where their $2.3 billion acquisition of Alphawave from earlier in the year acts as the perfect strategic wedge. Alphawave handed Qualcomm the ultra-high-speed connectivity tech they needed to take their highly efficient mobile cores, package them up, and deploy them into massive, sprawling server environments. They essentially solved the data center bottleneck, which allows them to bypass the traditional suppliers and offer a vertically integrated stack directly to those power-hungry hyperscalers. The AI-native smartphone. Now, shifting from the cloud back to the consumer, the reported partnership between Qualcomm and OpenAI is aiming to build something entirely new, a truly AI-native smartphone. By integrating next-generation memory and blazing fast storage standards like LPDDR6, they're architecting hardware capable of running highly sophisticated AI models entirely locally, right in your pocket. No constant pinging of an expensive cloud server required. This strategic shift signals the end of the traditional app era. We're moving away from manually tapping through a static grid of apps and shifting toward a dynamic system of autonomous AI agents. Think about it. Your smartphone is the only device on Earth that captures your complete real-time life state. This new hardware transforms the phone from a passive, reactive tool into an active, intelligent orchestrator that actually anticipates your needs right there on the device. The automotive growth engine.
But while data centers and AI phones represent the future, Qualcomm is already executing a diversification strategy that is yielding very hard revenue today. Their Snapdragon digital chassis platform is experiencing massive acceleration, recently crossing a $5 billion annualized run rate. The entire auto industry is aggressively transitioning towards software-defined vehicles, and Qualcomm is supplying that required computational horsepower, promising a 3x increase in CPU throughput for their next-gen platform alone. And for the neural processing units, the actual brains making split-second decisions for autonomous systems, they are projecting an unbelievable 12x leap in performance. These massive generation-over-generation hardware leaps are exactly what secures Qualcomm's dominance in Level 3 and Level 4 autonomous driving. And this isn't speculative. It's backed up by a staggering $45 billion design win pipeline. The PC market's new challenger. Meanwhile, over in the legacy computing space, a major battle is brewing. When you stack the on-device AI power of Qualcomm's new chips up against Intel's Panther Lake, the shift in dynamics is stark. Qualcomm is bringing these massive multi-core setups to laptops, armed with a 30% advantage in performance per watt. In an era where local power efficiency dictates everything, traditional x86 architecture is suddenly looking incredibly vulnerable to disruption. Valuing the agentic era. So how exactly is institutional capital digesting all of these moves? We're already seeing aggressive upward price target revisions from the major analysts. And yet, despite the recent run-up, Qualcomm still trades at a relatively modest 16 times forward PE ratio. That is a steep discount compared to AI infrastructure peers like Broadcom or NVIDIA. The market psychology here is clear. Wall Street is essentially holding its breath for the June 24th Investor Day. Once that mystery hyperscaler partner is officially unmasked and the true scale of their cloud integration is confirmed, we're very likely looking at a substantial multiple expansion catch-up. We are crossing into a phase where the strict limits of physical power will dictate market leadership. Software giants are being forced to transform into hardware designers just to survive the crushing, real-world cost of AI inference. If the silicon underneath the software is becoming the ultimate bottleneck, it brings up a much larger question about the future balance of power in tech. A decade from now, will we even care who makes the physical phone, or just who designed the intelligence inside it?
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.